which is nice. So you don't have to wait, because if you just upload a replay, it can sometimes take several hours. But here, when we're streaming on YouTube, you can get it up to date and immediately, which is really nice. So, welcome everyone. Thanks for being here today. Obviously, February 10th, we are over a third of the way through the month, which is just insane to me. How fast things get rolling along. So, talked about the agenda. We're going to do a quick update on where the market is, including our weekend trade, which is still open right now, with the market kind of in between. And then today's session is going to be a little bit different because we're actually going to dive deep into a particular strategy. I'm calling it officially Nate's boring earnings strategy. And so I'll talk about that. If you have questions about it at the end, I'll try to make some time for that. I'm sure we'll go over a half hour today. I try to keep these to about a half hour. Today we'll probably go a little bit longer because we are doing a full strategy debrief. But if you have questions, you can always drop those in the chat. I'll try to keep an eye on the chat. Usually I'll come back and kind of catch up on those questions more toward the end of our time together, but feel free to drop them in anytime. So let's start by just taking a quick look at where we are from a sector standpoint in the market. I think we're kind of in an interesting spot here. Let me get my controls out of the way because we have energy at the top. Now, that's not too surprising. We've talked about an energy rotation for a while. I don't think it's a shock here that energy's at the top. That's the green line that you see here. So that's energy. We're seeing that, kind of bounce up, bounce down. Last week we had a really on it, actually, in the first half of the week. And then, surprise, surprise, energy went from strong to weak, which is something we've been seeing over and over and over again. And now it's really strong again, up, over 1% today. This is energy right here at the top. Now, the interesting thing here is that we've got financials taking a beating today. We haven't really seen that. Financials have been probably the steadiest sector over the last couple of months. And so seeing the gap here with financials really taking a hit relative to the rest of the market is something new. So for me, I think financials are something I'm probably going to take a trade on. I'm going to give it another day or two to see if we continue to weaken. And then I'll take one of those, what I've been calling snapback trades here on the sectors directly. So this is one that I think could definitely set up for a nice snapback if it beats down just another % or two. Captain Dave said he cannot see my screen. Can everyone else see my screen with the sectors here? Green, all the colors. You guys can all see these? Yes, yes, yes. Okay. Dave, you might need to just reframe your Zoom. Everyone else is seeing me. So again, energy at the top, financials at the bottom. We've got some other things going on, like technology picking back up. If you've seen AVGO and NVIDIA today, ripping pretty good. Now, if we go back just a little bit further here we go. This is just a 5-day look at the sectors. Here you can see this is exactly what I'm talking about. Here's energy. Energy popped up nicely, was up over 2% going into the end of the week. And then here's energy again. Energy up 2.5% to 3%, down 3%. Now energy back up 2.5%. So this is exactly the kind of stuff that I'm talking about. To a lesser degree, technology gapped down a little bit just a couple days before this, ripped up 4%, down 2%, back up. You can see some of these other sectors having some big bounces in between as well. So a lot of rotation, what I'm calling kind of like short, rapid rotation in the sectors is a big part of what I'm paying attention to. And I'm trading these sectors pretty much directly. How do I do that? Typically with spreads on the sector ETF. So XLK, for example, is tech. If you want to trade on tech, you can trade XLK as a direct sector. XLE is energy. XLV is health. XLB is basic materials, so on and so forth. You can trade those sectors directly as ETFs in the market. And I'm doing that quite a bit lately, just trying to trade these ebbs and flows. So that's the sector. Again, this is the 5-day. We're seeing here, by the way, at the very bottom is health. That's the one I think could be an interesting snapback as well. So health and financials are the ones that I like. Derek, everyone else can see my screen, so you might just need to pop up your Zoom and reframe what you're looking at. Sometimes it's like in the more or the speaker view or something like that, but everyone else is seeing it, so just try to use your Zoom controls there. All right, let me just type in one more time, XLV. long potential. So that's health. Okay. And then XLF is the other one. Not going to do those today, but I think that those could be interesting for us in the next couple of days. Liberty, Dave, Derek, if you guys aren't seeing the screen, just try to use your Zoom controls there. You might have something that says like speaker view or something like that you want to change to full view. I'm not on your side of Zoom, so it's the controls aren't exactly the same for me, but I don't know if Dakota or someone else could type in the chat, maybe help those of you who are not getting the full view with the screen included. Might need to just change that view. Okay, jumping over here into our broad market. So this is the SPY we're on right now, the S&P 500 ETF. I've been saying lately, for me, I'm still cautiously optimistic. We did make a clear break of the previous high. We've done nothing since then, but we did make a clear break. So I'm cautiously optimistic that we'll break again and actually get rolling. But at the end of the day, we're really still at this November midpoint within a couple percent of that, which means the market has really gone nowhere in about 80 days. And so we're really in a net neutral market. I think I predicted this accurately when I said to you guys going back to November that we're seeing big moves, but we're not really making a ton of directional plays. We're seeing, big moves down, big moves up, big moves down, up, down, up, down, up, down, and we're not really going anywhere in the net impact of the broad market. So I still think we're in that market, but I am cautiously optimistic, as I've been saying, that we could see a break here and get some net movement. Now, that brings me to our trade that we took last weekend. So last weekend, we were looking at this. Let me just zoom in here, this Friday candle. And we were saying, based on how aggressive this candle was, the more likely scenario is that we'll get a pop up. Now, that's unfortunate for my two-way traders because we actually just needed a dollar or two more to the downside to get a win, and a bounce to the upside puts us back in between for a loser on on two-way options, which is a real bummer. But for the weekend trade, it's a good thing. Now, the problem is we moved a little bit lower on that before the end of the day, before we actually got this gap up. So all I needed at the time, right about here, was a 0.5% move. But by the time we got to the end of the day, we needed more like a 0.85% move. So we just pushed it a little bit lower and didn't quite, stick to the area where we were playing the trade from. I know this is hard to explain verbally, so hopefully I'm making sense. When the market was at 602, we only needed, half or 0.6%, but by the time it got down to 600, we needed a larger move. So where that trade sits right now is just a little bit above break even here. This is the trade that I'm referencing. I might go ahead and close this in the next hour or so. I did actually already close a couple contracts. That's why you see my P&L today on this particular trade is up about $500 because I closed a couple of them at the market open and then left some on today. Again, in the break-even range here, maybe about 10% up. If we can pop up to 606.50, for example, on the SPY, we'll obviously get to like 100+% gain. So that would be great if we can hold out and get a little bit of a move. But at the same time, just going back to our other chart here, here we go. If this drops down more to the bottom of this range, that trade's going to be down 80%. So I'm being careful, but I'm going to hold out here for another hour or so probably. If the market makes a pop towards 606, I'll close the rest of it. If it just kind of stays sideways, I'll take a break-even trade. So that's just the update from last weekend's trade. I don't know how many of you guys are in that trade. If some of you already took profit, if you're still waiting, which I am on the majority or about half my contracts as well. But I just wanted to at least follow up with that so that you had an update. Because when we do a live trade together, I try to follow up as often as I can on those free trades. Obviously, it's for me, there's a lot going on, a lot of services, things like that. So I'm not able to follow up on every single free trade that we do together, but I try as often as I can if a free specific trade was given up, just to give you a follow-up and some instruction. And so I want to do that today and kind of circle the wagons there before we get into the strategy side of things, which is, of course, related to our earnings trade. So let me move into that. for everyone next because today, a little bit different. What I want to do is I want to talk about the earnings trade that we are looking at today. Last week, I mentioned this strategy and the fact that I'd used it on CLSK, and I asked if everyone would be interested in me actually covering exactly what this boring earnings strategy is. And I got great feedback that you guys would prefer me to cover that strategy. So I thought, let me just turn this session into more of a step-by-step strategy session. Take notes, all that good stuff. And then if you want to even do the live trade with me, I'll go ahead and put on my particular shop trade today. Normally, I would put this trade on at like 3:45 right before the market closed. But I thought, why not just go ahead and pop it on today during our session so everyone could see it live. Now, it is actually more like a 60K trade than a 50K trade. 50K was a nice round number. We're going to be more like 60K here on Shop because Shop reports in the morning. So let me jump into that. If you guys have questions, like I said, you can pop them in the chat. I'll try to keep an eye on the chat. But more than likely, I'll kind of circle back and handle most of the questions toward the end of it. And if you have any of those, that no problem. Okay, let's talk about earnings. So earnings often represent the biggest moves on individual stocks over the course of the year, right? We all know that. They tend to respond, the actual earnings, the actual price action, on a mysterious mix of the actual earnings results, okay, what the numbers actually look like, forward guidance, both, their actual guidance numbers and, what they say about their potential, the overall sentiment about the market and about that stock in particular. In other words, are people really bullish on the market? Are they really bullish on the stock particularly? What is the sentiment like in the market? And then what I call the spin zone. What are they able actually to apply to those numbers from an outlook perspective, from a, kind of why it's good or why it's bad, all that kind of stuff that the actual company themselves can put in the spin zone to make it either, positive or negative, because sometimes they actually negatively spin that stock. And so the market then responds based on all of those factors. And like I said, we often get very big moves in either direction. So how do most retail investors trade earnings? You guys can pop in the chat if you want, but I think it's a pretty simple 3-step guideline that most retail traders trade earnings. Step 1, pick a direction. Step 2, buy an option. Step 3, pray. That's pretty much how I would sum up how most retail investors trade earnings. They're picking a direction. They're usually buying a call or buying a put, and they're hoping for the best, that trade is going to work out and they're going to hit a home run on it. Now, most options fail on earnings. I think this is probably not news to everyone, but just in case you're wondering, yes, most options do fail within earnings. And the reason is because marketers know that earnings are happening, right? Duh. I mean, it's not a surprise to the market makers like that Shopify could move a lot tomorrow. They're not going to be like, oh, crap, we forgot to factor that in. They know that. And so, of course, the options are priced sky high, right? The inflated price of options are incredibly extreme before earnings. So what that means, just very practically, is that you have to pick the right direction, long or short, and then on top of that, you have to get a massive move in the right direction to make any money. So this is an example of Shop right here. Not a crazy option, 127, just a couple percent out of the money option. And you need to break even right here, a 9% move in your direction. So just to be super clear here, if you're trading this option on Shopify, you need a 9% move in the correct direction, not to make 1,000%, to break even. So that's why most options fail, right? I mean, that's just a lot to ask for. To get the direction right, to get a massive, massive move in your direction, and then to overcome that move to actually start making any money beyond the break-even point. So here's the conundrum. Earnings really do move stocks substantially. Sometimes I hear people say things like, At the end of the day, earnings really don't move stock. It's just all pricing. It's all blended in. People get excited, but they don't really move. That's crazy. Of course they do. They move a ton. So earnings really do move stock substantially. Therefore, there is an opportunity, right? So that's the conundrum, that there really is an opportunity there. So let's think about this. The stock has the potential for a big move. We want to tap into that potential, but we can't use options because they're so overpriced. I shouldn't say can't. Maybe that's too strong a word. We'd prefer not to use options because they're so overpriced. So they start stacking the deck against you as soon as you want to use options. What if we then traded the direction without paying a single penny for the implied move? Because that's what you're paying for in regular options, right? You're paying for this new big potential to untap. And we actually use the overpriced options to our advantage at the same time. So we traded a directional move in the stock, but we didn't buy the option that pays for all that implied volatility. And at the same time, we actually flipped the option on its head, where we use the implied volatility, that overpriced option, to our advantage. Well, enter Nate's boring option earning strategy. Okay, so this is what it's all about. Better known as using a covered call to trade earnings. Now, I'm going to be perfectly honest with you. You go YouTube around exciting earning strategies, how to make triple digits on earnings, you're not going to come across a lot of covered call earning strategies. But for me, this is a fantastic opportunity that most people don't know about. Why would we use a covered call trading earnings? Because we're buying the actual shares of the stock when we're using a covered call. So we're buying actual shares of the stock instead of the options. Therefore, we're not paying a penny because there's no implied move in the shares of a stock. It's just what the current price of the stock is, period, end of story. So we're not paying anything for the implied move. At the same time, we are selling an option on those shares. So what we're doing is we're tapping into the potential of the big move, but instead of paying an exorbitant price for the options to do that, we're actually flipping that price on its head by selling the option back because it's very overpriced. So that really flips the entire earnings approach on its head. Instead of going for a low probability home run trade, we're actually using earnings to go for a high probability juiced earnings trade or a juiced income trade. So far, that's just the theoretical logic. Hopefully that made sense. Okay, again, if you're new to options, maybe you're still catching up a little bit, but for everyone else, does the theoretical logic make sense? We're going to buy the shares themselves to get our potential, and we're going to sell that overpriced option to take advantage of that. Does that make sense to everyone, just on kind of on the theoretical, logical level? Give me a yes in the chat for all of you who are in Zoom. Yes, yes, yes. Okay, good. So then let's actually get into the scenarios of how it works. And I have one little kind of tricky slide at the end here that I think is the most undervalued component to this whole thing that most people don't factor in. And we'll get into that at the very end. But first, let's get into the actual scenarios. Okay, so here's Shop. I just took this like 20 minutes ago, so it's within range. I think it's bounced up a little bit, but this is within reasonable. Shop is trading about 120 bucks, right? $120 a share. So options require about a 9% move to break even, right? That's what that move I just showed you. That's not me guessing. That's what the actual market makers are predicting on the price. So that means the area for profit exists beyond that range. That's the move that you need just to get past break even to start making any money, is beyond that 9% move in either direction. Everything in the middle represents lost money. So anything in between those ranges on the options equals lost money. Now, just to be clear, this is if you're trading in both directions, which you're not. You're picking a direction. So if you're bullish, it's actually just one side represents money, and everything on the other side here is lost money, right? Just to be clear, if you're bullish, that entire thing is lost money. And then if you're bearish, everything up here is lost money. So it's actually even a lot worse than the drawing shows you, because you're not getting both sides of this. You're only getting one side of this based on the direction that you trade. And if you wanted to trade it in both directions, then you would make the range much, much, much wider and much, much worse. Okay. So let me pause for a second. It's certainly possible that Shop will move beyond this range. But we all know statistically, it's much more likely for Shop to end up within that range because the vast majority of earnings plays end up underperforming the implied volatility, right? So at the end of the day, between now and expiration, which is this Friday, it's much more likely that Shop will end up between those zones. So let's restructure it with Nate's boring earnings trade instead of the traditional options play. Let's just go through it again and restructure it within the same, same stock, but with my boring earnings trade. So again, here we're going to start at $120, but step one is going to be to actually buy shares of Shop. Remember, we're buying the actual shares. Step two is going to be to sell a call just inside the expected move. Okay, that's step two. We'll get into specifically what that would be, but you know the expected move, so you just go a couple bucks inside that. The upper range here is our best case on this trade because it maxes out the value of our stock holdings. Okay, so that's the best case, is that we get the most value out of the holdings of the stock. But the middle range is very profitable too because the call we sold expires worthless. When you sell a call, the most value you get out of that call is if it underperforms. It expires worthless, so you get all the money for selling the call, which makes this middle range very valuable as well. Plus, we get some profit from the stock because it's moved up some. So that middle range is really profitable as well. And even several dollars below the price is profitable. So if you buy Shop, you sell a covered call, and it moves down a little bit, it's actually still profitable because of the value of the profit from the call being bigger than the value of the shares decreasing. Okay, so we've got a lot of range of profitability here. And even more importantly, if we dip into the red, if we dip beyond the move where we start losing money, we don't flip automatically into 100% loss like an option. An option, as soon as you're on the other side, as soon as you're in the red, you're losing 100%. Here, we gradually move into a very reasonable downside. If it moves down $5, we lose 1%, $6, 2%, so on and so forth. So it's a very gradual, reasonable downside risk. So just to be very, very clear, yes, this boring earnings trade caps your gains. You're not going to be making 100% ROI on Shop if you trade it with me today. Absolutely not. But the beauty of the strategy is that it not only flips a low probability strategy into a high probability strategy, but it flips a massive loss potential strategy into a mitigated loss potential strategy, which I think is what most people overlook. It is actually a huge, huge part of the key here. So let's go through the actual scenarios, which I think are kind of amazing. So let's say that Shop barely moves on earnings. It basically ends up right around the price that it is right now. It goes up, it goes down, but it ends up right around the same price. Well, my strategy is going to make about 4 or 5%. Regular options are going to lose 100%. Let's say Shop moves 5 to 9% up. So it makes a move, but it's not a big enough move for the implied. Well, this strategy is going to make anywhere between 5 and 12% profit. Regular options still lose 100% of their value if it underperforms the expected move. What if Shop perfectly hits that expected move? So it moves up 9%. Well, we're going to make about a 12% profit. Regular options are going to break even. What if Shop moves over 10%? Well, we're going to make about a 12% profit. Regular options have unlimited upside. This is where they shine, right? Unlimited upside. What if Shop moves down 1 to 4%? Well, we're going to make a 1 to 4% gain, even if Shop moves down. Regular options are, of course, going to lose 100% if you're trading long options. What if Shop moves down 5 to 10%? Well, now we're going to lose 1 to 5%, depending on how much it moves down. We're going to start to take a loser, but a relatively small loser. Of course, regular options lose 100%. What if it moves down 10% or more? Well, now we could take a bigger loss, right? If it has a crazy, crazy move, we could take a 5%, 12%. I mean, we could take a 15% loss. It can move down very far. Regular options lose 100% if you buy a call option. So this is why I think the scenario is so interesting, is that in almost every scenario, you're much better off doing a strategy like this. The probability and the risk mitigation is really advantageous. And that's why, even on this quote unquote boring strategy, I really like trading this way. Just one more thing to consider. And I think this is probably the part that no one really considers. Most people, might consider this, okay, the advantages in the scenarios are really good because regular options lose money all the time. But I think there's one more thing to consider here that's really important. On face value, an option could go up 100% or 200% compared to an average win of, say, about 8%. And that might sound like too large of a gap to overcome. Like, okay, yeah, I get it. Most of the scenarios, they favor the covered call, but I could win 200% on an option. So to get the gap from 8% to 200%, it's just too massive of a gap. And therefore, even though the scenarios might be better, it doesn't necessarily make sense. But I think this is really the key that most people ignore. When you put this into real dollar perspective, it changes the landscape quite a bit. Here's what I mean by that. I'm going to put about $60,000 into this shop trade, but I would never put that into a binary options earning trade. I would never spend 60 grand on the call option ever on an earnings trade. So technically, I could lose $60,000 today, right? Shop on their earnings could say, oh, by the way, we're going bankrupt. The stock could go down to $0 and I could lose everything. So just to be super clear, I do have $60,000 at risk, right? In reality, I'm treating it like I have 10% risk as my worst case environment. I could lose 100%, that's true. But in reality, in practice, I'm treating it like I have 10 or 12% max risk. Because even if an occasional stock does drop 20%, the net average of my losses is going to be within 10%. It's actually going to be much smaller than that. But in reality, I feel like I'm risking more like $6,000, right? Even though I'm putting 60K, and again, just to be very, very, very clear, I do have 60K at risk. I'm treating it from a system perspective like I have about $6,000 at risk. Because at the end of the day, if you did this a million times over, even on the crazy drops, your blended max risk is going to be less than 10%. So with that perspective, what I would more accurately compare is $6,000 worth of options versus $60,000 in my boring strategy, in which case the 100% win on the option is actually equivalent to the 10% win on the Nate boring earning strategy. Okay, so when you compare it for actual dollar figures, it's very interesting how it changes. And since the stock going down through expiration would be a lot less than 10% on average over the course of many trades, whereas the call option is always going to be 100% loss if it goes down between now and expiration, it's actually even a little more advantageous that. You could maybe say something like, forget that, more like 150% is equivalent to an 8% win. You could make it more dramatic than that if you actually did the real figures over a system period of time. And I think this is the part that most people really undervalue. They say, oh yeah, but you can only win 8%. I can win 200%. Aha. But how much money are you putting into the equation here? Because that's a pretty important factor when it comes to risk to reward. How much actual money can I stand to make, right? That's really critical when it comes down to evaluating a strategy and whether it's worth it. And so for me, that piece of the equation stacks up on a trade like today where I'm willing to put, 60 grand. Now I have the potential to make 6 grand in real dollars. Whereas on the earnings trade on a binary option, I might put 5 grand down. And what's my potential going to be there? Well, maybe 6 or 7 grand. So kind of the same upside potential, but with all these other advantages. Does that make sense? Does everyone understand? Because this is, again, this is something no one talks about when they talk about trading and the reality of how it works in real markets and systems and risk to reward and profit factors. Uh, this part of the equation, I would say, gets completely ignored in every single strategy or training that I've ever participated in. But hopefully this makes sense that when you actually get down to brass tacks, it matters what the dollars are going to equate to in a trade potential like this. Yeah. Okay, good. So let me get into the actual trade then. So let's go ahead and look at the actual trade. Oh, by the way, SPY bouncing just a little bit here. So we'll give it a little bit more time. Bouncing a little bit, trying to get up over that 605 level. All right. And by the way, just an interesting note here. I'm doing this in my small account. So I'm doing this in my small account, even though I'm going to trade 60,000 worth because I'm not treating it like $60,000 of risk. Just again, just to kind of verify that last point here. Okay, so let's go look at Shop. Here's Shop. We zoom in a little bit here. I'm looking at it right now on the daily chart. You can see been kind of hanging out in this zone, actually similar to SPY, except for instead of a descending wedge, we kind of got the ascending wedge, potentially breaking out. I'm hoping Shop goes to 125, maybe even would go to 130 bucks. I think a lot of people are hoping that Shop absolutely kills it and goes to 140 bucks. And then, of course, some people are trading it to the downside as well. And I think there is potential for Shop to go to the downside. It has missed on earnings, several times in recent memory. So I think that's very much the potential. One of the reasons that I'm bullish on is that they did kind of restructure their forward guidance. And I think it makes it easier for them to get a potential beat today. But really what I'm trading is just a minor move. If it goes up a couple bucks, great. I can trade it and get, that 8 to 10% win, even on a couple dollar move where I'm able to leverage a lot more size. Now, if you go look at where we're at today in terms of options, you can see relatively even. 70K in calls here, 56K in puts on total contracts. No crazy bias here. The trades that are more aggressive above the ask, in line, 13 and 9. So nothing too crazy. And that's actually what I like to see. When I'm just trying to trade, a medium move on a stock, that's pretty much where I like to see. I like to see nothing too crazy. But what I love about Shop, the reason I'm using it today, isn't because of my directional bias. It's because of the expected move. Why do I like the big expected move? Well, because I can get more value out of the call. And the whole point of Nate's boring option strategy or earning strategy, as I've dubbed it as of today, is that I want to take advantage of selling that call. And so for me, this advantage is really significant when we get big expected moves. In this case, over 10% on the expected move. Now, like I said, the option itself, the implied volatility on that 127 was about a 9% move, but the expected net dollar move is about a 10.5, 12% to 12% move, depending on how this shakes out. Okay, so what does that actually look like? Well, before I buy the shares, let me just go ahead and show you the chain. So we're going to go to the shortest expiration date. We always go to the shortest expiration date. Today's Monday, so we're still 4 days away. I love trading these on Thursdays, by the way, because I can box it in and only give it 1 day to make a move. But today, it's Monday, so we have about 4 days left on the trade. That's the first thing we do. The next thing we do here is we go to the out of the money options. What we're looking for when we trade these is these options that are up here in this range. These are the options we're looking at because these are kind of just outside that expected move, right? I mean, 134 is actually still inside the expected move, which is crazy. That's a huge move. But these are just outside, just underperforming the expected move. And that's what we want to see. We want to see, can we get some really good value up near the top of the expected move? And we absolutely can. The value here is significant. you can sell this call for about $4 a contract, which is just beautiful in my personal opinion. That's a lot of value for a $10 move on the stock. Because again, more often than not, Shop's going to underperform that expected move. Now, the great thing is, if they overperform the expected move to the upside, I don't care. Still great for me. But if they underperform, it plays perfectly into our advantage. Okay, so you can see here, these are the values. To get the value of the sold call, just go over here on the left side. That's the call side. And then over here on the bid is where you can see what kind of value you get out of the sold calls. And that's what we're looking at. This 130 number is great in my opinion because it's over $4 and it's still a full $10 away from our current price on Shop, which to me is great. So let's go ahead and start with buying shares. What I'm going to do here is I'm going to buy the shares. I'm going to buy them. Whoa, sorry. I'm going to buy them here for about $120.76. Now, 500 shares from me is going to cost, as you can see here, about 60 grand. So I'm going to buy about 60,000 bucks in total shares. Sorry, let me move that over. Just trying to make my screen a little bit bigger here so you can see. This order is working. Shopify is bouncing, of course, right as I put the trade in. So let me just give it a minute, see if it bounces back. But right now, I'm just buying shares at the current price. Okay, it's 120.88, so it just bounced a little bit. Let me see if I can get right in here at the current price. Oh, moved up 4 more cents. Come on, Shopify, chill. There we go. All right. See, just filled 500 shares, 120.88. Thank you, Shopify. Okay. Now, once you buy shares, what you can do is you can sell one call for every 100 shares you own. So you have to buy at least 100 shares, but if you buy 200 shares, you can sell 2 contracts. 400 shares, you can sell 4 contracts. 1,000 shares, you can sell 10 contracts. Now, normally, buying 100 shares for a covered call isn't all that sexy, right? Because you're going to sell like a 30-cent option against your covered call or against your stocks. And so if you just own 100, it's not going to do a whole lot for you. But in this case, just buying 100 shares, which would be about 12 grand, only about 6 grand on margin, you can sell that option for like 400 bucks. So you're actually getting a pretty decent value even with just 100 shares. Now, once I've sold those shares, wow, sorry, I'm trying to read and talk at the same time. Once I've bought my shares, I can now sell the covered calls against it. And that's exactly what I'm going to do. I'm going to go right back to here, again, the shortest expiration date, and I'm going to sell one contract of these 130 calls here for every 100 shares I own. So in this case, I'm going to do 5 because I bought 500 shares. So what you're doing is selling to open the 130 shop call option. And you're getting a credit about $4.35. So about $435 a contract. Let me just finish typing this in the chat for you. Feb 14th. Okay, so I typed that in the chat. Obviously, you have to own the shares first. That's step 1. You got to own the shares. And then for however many you own, you can sell one contract against every 100 shares. So I'm going to go ahead and juice this up to 440, see if I can get filled. Now, what you'll see here on my screen is that I'm going to make about 2,200 in actual credits for selling those options. Okay, that's what I'm going to make. So what that actually gives me is about $2,200 a buffer to the downside. That's pretty darn good. And then it gives me $2,200 of juice, extra profit to the upside. And then once I get over 130, if it does, then I'm just at my max profit on the actual shares themselves. So this $2,200 serves as our profit in the middle. It serves as our buffer to the downside. And then at the upside, it's just capped out and we make all of our money on the share side. And that kind of goes back to those different scenarios that I was showing you before on the different areas. Oh, that filled. I might even be able to get more than 440 on those. That filled right away. So again, you're buying the shares and then you're selling this, what they would call a covered call against those shares. For me, this is a way to not just get a really good risk reward, not just get a high probability and kind of juice those income trades, but it also, like I was just saying, is something that I can put more cash into, which juices up my potential. So if we go to the chart, let's take a look at our actual scenarios here. Here we've got Shopify at, $120.66. If Shopify does anything above the current price, we're going to do really well. Why? Because we're going to make money on the actual shares, plus we're going to make money from that covered call. Now, if Shopify does anything below this, we start to lose money on the shares, because if the share goes down $1, we lose $1. But we have this whole buffer zone here that exists where we're still in the money because the call makes more money than we lose on the shares. So this is still dollar. It's not as big, but it's still a money zone. Then we have this area where we start losing money on the trade, but we're not losing 100% like you were on an option. We're starting to lose a little bit, down 1%. If it goes further, down 2%. If it goes further, down 3%. If it goes further, down 4%. And you're starting to lose money on the trade, which of course you can. But the zone of where we can make money is huge, because it's literally, take something like 115 and everything above that is all profit. So if we bounce up, we make money. If we bounce up and come down to the middle, we make money. If we go sideways, we make money. If we go down and then back up, we make money. You know what I'm saying? All these scenarios are all in a very, very big range of money-making possibilities. And not only that, but if we start going down and we underperform, then what we can do from there is have a mitigated loss, because we're still getting all that credit, all that premium from selling the call as our advantage. So for me, this is what I would consider a boring strategy as far as most people trade earnings, but a really fantastic opportunity to put yourself in lots of money-making position. And by the way, as you get comfortable with this, you can do all kinds of different stuff. You could do a synthetic version of it where you buy an in the money call. You could ladder it where maybe you sell one call at 125, one at 130, one at 135. This can really get advanced and dynamic as you become more comfortable with the strategy. So for me, this is a strategy I like. The goal here for me is by Friday, if I'm in between the zones, I'll get rid of both trades. I'll basically buy back the covered call for essentially nothing, because it'll be worth almost nothing, and then I'll sell my shares. If it's above 130, I'll do nothing. I'll let my trade get called away. And if I'm down, I'll just manage it. I'll sell the cover or buy back the covered call for, basically next to nothing. And then I'll get rid of the shares as well. So our break even here, great question. Where's our break even going to be from Larry? It's going to be once the stock falls far enough to where your sold option does not cover you. In this case, we're getting about $4.50 for the call. So the stock would have to drop more than $4.50 before we start losing. So that's how you know your break-even point. Basically, how much did you get for your covered call is also your buffer for how much the stock can fall. Rob, yes, great question. Rob asked if you buy an in the money call, are you still paying that higher implied volatility? Yes, just not nearly as much as the out of the money call. So you still are paying an increased price for the in the money call. It's just not as high as the out of the money call. Yeah, Larry, you can. So again, once you get dynamic with this, you can do a lot of things. You can do the synthetic. You can ladder the different sold calls. You can buy some protection at some strike places below. You can even do what I would typically do with a directional debit spread on the put side, where if it breaks below something extreme like 110, you have a big profit opportunity. So for example, you go to shop, you switch to a vertical, right? And then you go all the way down here to something extreme like 109, 110, right? And you can buy this for 25 or 30 cents and make about a 300% gain if it falls all the way below there. So you can do lots of different stuff once you have this framework in place, because your core position, in my opinion, is so very healthy on this. So a lot of different ways that you can maneuver it that I think are really great. Now, my ideal scenario here is that shop crushes earnings. It goes up to $170 for all I care, and then we just wait to get called away on Friday with our max profit. So that's my ideal shape. By the way, SPY bouncing here up to about 605.15. I'm going to go ahead and set a target for those of you who are in this Friday trade. I'm going to go ahead and set a target here on this vertical. This is our 605, 606 trade that we put. Oh, didn't grab it. Hold on. Let me do it again. This is our 605, 606 call we put on together. I only paid about 20 cents for this call. So, or 25 cents, I guess. So I'm going to go ahead and I'm going to put a big healthy target here of 75 cents just in case we get another pop here. So that's a big target. That's like a 200% gain. Probably won't get hit if we're being honest, but I'm just going to throw it there just in case we get a pop on SPY. And then if I don't get that pop, I'll just close it here another 40 minutes or so before the market closes. Craig, we have the two-way trade. If you took this trade and made some money to balance out, great. If not, the two-way trade is going to expire worthless here in about an hour and a half. Of course, super big bummer. Every time I feel like I'm on a hot streak with a strategy and I reveal it for the first time, the first trade never goes as planned. It's the most obnoxious thing ever. But obviously the two-way trade has about an 85% chance of winning. So about 50%, 15% of the time, we end up in that situation when we just let it expire worthless, which will be the case today. I'll send an update at the end of the day where we are, but unless something crazy happens, that's the situation we're in on the SPY, where it's going to end up right in between our levels, even though early on in the trade it peaked down, later in the trade it peaked up, and then ended up right in between kind of our core box on that particular trade. Okay, folks, we have gone about 20 minutes extra so far on this session. I hope learning this strategy was valuable. I hope you were able to take some notes. I know this is a little bit different than our typical kind of live trading active session, but if you guys like these kind of nuanced strategies, these are the kind of strategies for me that probably won't ever, be like a full service, but they're things that I do on the side. So if you like that kind of stuff, I'll take every once in a while on one of these sessions and just do more of a strategy session, versus a live analysis session, and kind of teach you some of these things that I use. Most of them are going to involve options. Most of them are going to involve kind of applying options in a unique way. And if you like that, then I'll put together some more kind of slide deck style, step-by-step instructions, and do those every once in a while. Because for me, having those in the back pocket are what I love most. Obviously, systematic strategies are what I focus on. That's the core of what I do. But what's the most fun for me are these kind of back pocket, fun, unique strategies that most people just never hear about. And so I like to try to do that. If you're new to options, you're probably like, Nate, I just wanted to know, how to do the debit spread. And this is earnings specialty nuance trade. But as you learn, hopefully, this kind of stuff will become, more advantageous and more advantageous for you over time. So thanks again for being here. Sorry we went a little long today. Took an extra 20 minutes or so, but yes, it is recorded, Rob. It's always recorded. You can go right to YouTube and get it immediately. I think I even actually drop the link somewhere for that. Here it is. Let me just drop the link. If you guys want to grab the link right now, you can go into YouTube. Right now, it's going to go to my current live session that's still active, but you can literally go and just rewind it and start from the beginning, which is the benefit of YouTube. So thanks, everyone. Hope you have a wonderful day. SPY is ripping. We're up about 80% now on our weekend trade. So 2 for 2 on weekend trades. Let's keep those up. Friday, we'll do another one. Thank you, everyone.